It is our final video for Business 630 for the Fall 2 session. This is Professor Hasse speaking one last time from Claremont, California. Today's date is Friday, December 16th, and I just want to go over a final few things as we finish up our course and you finish up your electrics case work. I will be around all weekend. If any of you have any questions or concerns, all the work needs to be posted by midnight on Sunday. First of all, just wanted to say that I've been very impressed by all your work in this course and your diligence. I have posted case number 3. There is no solutions to case number 3 since all of us are doing in a specific company. The only way I graded the case is basically, first of all, was your information accurate on your various 4 financial analytical equations or relationships? Did you have a comparison or some information relative to the industry average or their competition relative to those financial analytical terms? And if the presentation of your paper made sense, it read well, it was set up well, that was another final determination. Everybody did a great job, and I want to thank you all for that. And you all have shown in this class your ability to do different formats to complete your work. Now, granted, yes, we had some templates and we had some examples, but all your work has gone beyond those templates and those examples, and you've done a superior job. So I want to thank you. Another thing you should do this week as you're heading to the last weekend of our class is make sure you understand and know where your grade situation is. All the grades are posted except for the electrics case, which will be posted early next week. So make sure you're familiar with where you stand in class. If you have any questions or concerns about that, please let me know. Do not wait until next week. It might be too late. So if you have concerns, questions, no problem. Just let me know. But all your grades are posted, so please take a review of that. Secondly, remember, I would like you to make sure that if you can this weekend as you complete your work to go to the course syllabus, calendar, and information file folder and click on the course evaluation link to complete the course evaluation for this class. It is anonymous. It's important. It's important to me. It's important to the program to get your feedback about this Business 630 class, the online format, and how it was delivered to you. And was it valuable? And where were there any problems? So please click that evaluation. It's very important. And it's part of your way of being further engaged in your education, in your school, and into the quality of our MBA program. So I'd appreciate it if you click on that when you're done with the course. So remember, we are finishing up the electrics case this weekend. We've had significant amounts of reviews, videos, information. Many of you have supplied your drafts of your work to me to review. I think some of the big stumbling points coming into this final weekend is, I think number 1 is how to handle the 2 variables of sensitivity analysis. One variable is pretty easy. It's the average base case analysis dollar per unit sales, which is $9,200. There it is right there. But the second one requires a little bit of thinking, a little bit of analysis, and it's the variable of the cost of the controller. The cost of controller is made up of 2 variable costs. One variable cost is pretty easy to figure out. It depends on the product. The variable cost of the unit for the product is a combination of either $1,280 for one controller or $1,260 for the other controller. That's one variable cost. But the second variable cost that makes up the cost of the controller is the variable cost per unit of warranty. The warranty of the controller spread out over 5 years, discounting those 5 years into one number, and that's your variable cost. So that's the combination of your variable for the sensitivity analysis, and how you do that, how you show it, how you place it into the average base analysis to determine the NPV of those various percentage changes. That's what I'll be looking for. The second area of some concern with some students is naturally, do I have the correct depreciation schedule? The depreciation schedule is a marginal accelerated cost recovery schedule of a class of assets. You're looking for the class of assets that has an 8-year distribution percentages totaling up to 100% for your depreciation schedule for this 8-year, $17 million project. Your total depreciation after you're done with those percentages over 8 years should total $17 million. If it doesn't, something's amiss. So make sure you look at that. And then finally, the third area of concern and questions that I get a lot of this past week is the capital structure calculation using for the weighted average cost of capital. Capital structure in this problem requires a little bit of thinking. It tells you that the desired capital structure is debt is 50% of equity. That does not say debt is 50% of assets. So your job is to determine what debt to equity is 50% and how does that equate to debt as a percentage of assets and equity as a percent of assets. That's the third key area. And then finally, the fourth area has to do with the writing. Answering the questions, using your calculations as exhibits, referring them to an exhibit, referring them to your spreadsheet, and setting up your spreadsheet in a organized manner that I can look at your calculations by tab, as you can see here in our file folder for this case. So besides doing all the calculating, doing all the writing, part of this is just like any other manager or leader of an organization, you have to present it in a format, both calculations and writing and interpretation, that a user, another party can understand and relate to. That's a key part of the case. Not only doing the calculations, but doing the presentation in the format that the reader can understand what you're trying to say and look at your calculations in a uniform, disciplined, organized manner. That's the key. You'll be marked off big time if it's helter-skelter, no sense of organization or discipline in your interpretation. That's a key to making sure you want to be successful in this case. So again, go back and look at your grade average coming into this class, and then take a look at how you're organizing this case and moving forward. I think all of you are, what I've seen so far, are doing a great job on this. And if you just take a little bit extra time this weekend and organize it and put it all together, you'll be rewarded with a good grade and a good grade in class. And you don't want to spoil. A lot of our students in this class have a pretty good grade average heading into this work. But remember, this work is 25% of your course grade, and a little bit of a hit in that, like under 90, under 80, could affect your final grade. So that's what you need to take into consideration as you go forward. Great. I also want to talk about a little bit about one last subject out of week 8 that, again, we're not being assessed at, is what I've been telling you earlier this week, but alternative capital strategies, and one of them is lease financing. When I started out my business career as an entrepreneur, I had my own business. I didn't have any money. I was by myself. My wife was doing my secretarial and office duties, office management, paying the bills. We were by ourselves. We were by ourselves for 5 years. I didn't hire my first employee until my 5th year of business because I had no money. I was concentrating on developing my network of clients and customers, developing a reputation, and developing a business model that down the road would enable me to go out and borrow some money and find equity to invest in my business. And one of those ways of doing that, it was, instead of borrowing money, using capital and borrowing money when I had very little credit anyways, was to supply the assets of my business by leasing a computer, leasing an office space, leasing a telephone system, leasing, if you can believe it, office furniture. And so by leasing, I could incorporate those costs, those operating expenses into my business model, my business plan. I could pass those operating expenses on in the markup of my cost to my customers as my billing cost, and I could recoup those expenses. I didn't have to use up any credit because I wasn't borrowing any money. I didn't have any interest expense on borrowed money. I didn't have the cash flow issues of paying off principal and issue and interest. So it kept my business a lot simpler, and it was a good alternative to going out and raising capital just for the sake of owning assets. But one of the downsides to that, which I quickly found out, was that I lost and didn't have many tax deductions. I had no deduction for interest expense. I had no deduction for taxes on those assets. Losing those deductions hurt. But naturally, the lease and the payment of lease was an operating expense of the company, which technically is a tax deduction. It's a business expense. But as I generated growth in my business around the third and fourth year and generating capital, generating cash flow, I found the need for tax deductions, the need to increase my credit situation, to go out and borrow some money and buy some of these assets and convert them from leasing into ownership of assets. And that's the general pattern of most businesses. As you begin to generate cash flow, credit, reputation, then you go out and purchase assets with your credit and grow the business more, because with the purchase of all those assets, you're not only driving or drawing revenue or cash flow from the work coming with those investments, or the revenue being produced by those assets, but also you're getting a tax deduction and lowering your deductible tax because of the expenses you're allowed to deduct for ownership of assets. So that's a key point. And a lot of you will be, probably many of you, some of you already are running into that as you're developing your maybe side businesses or entrepreneurial businesses. Down the road, you have to make that decision of going from a lease funded capital to a debt or equity funded capital. And that's a key part of corporate finance. So it's important to understand that the importance, especially to the small businesswoman and businessman, the advantage of leasing. And I've provided a spreadsheet just for the sake of you to see. It's here, right here, chapter 19, lease example. And let's take a look at that spreadsheet. Now, for some of you, this might come in handy as you're developing your career. And I found it handy as I was developing my career when I started to make investments. I started to make real estate investments. I started to determine what was the cash flow going to be generated from an investment in real estate, the loan payment, the interest payment, the amount of depreciation I could deduct on that asset versus the amount of revenue I could be receiving and expenses associated with that. That was a good analysis of determining the discounted cash flow of an investment. And naturally, the higher the interest rate on the loan, the less chance I could recoup that cash flow. But if I had cheap money, sometimes it was cheaper to own an asset instead of leasing. Well, here's an example here in this spreadsheet of a company that has a 4-year piece of equipment that they're going to finance, or have an option of financing, or have an option of leasing. It's $1.5 million equipment. Now, if they decide to finance, it's going to be a non-amortized lease, meaning interest payments only for years 1, 2, and 3 of the ownership of the asset, and then the full amount of the loan, 1.5 million plus the last year of interest, to be paid off in the 4th year. So in order for somebody to get this deal of a non-amortized loan, you have to have pretty good credit, or have to have some collateral behind you, like a small business arrangement with Small Business Administration, or somebody co-signing on that loan. You have to have something backing up as collateral. A lot of small businesses don't do that, but we're assuming in this they do. So they get a 9% or 15% loan, ouch, and they get which is an after-tax interest rate if they're in a 40% tax bracket of 9% after tax. So they go ahead and they pay out the interest in the first 3 years and pay off the mortgage or the loan. They can deduct the interest expense, they can deduct the depreciation, and here's another schedule of marginal accelerated cost recovery depreciation for a 4-year life asset. Notice it totals 100%, and you're deducting that in depreciation after taxes here, and you generate cash flow. So this investment is generating positive cash flow on this loan and this deductibility of the expenses. And then in the final 3 years, you really get hit by the cash going out mainly to pay off the loan. But if you discount those cash flows back at the after tax discount rate of, you get basically a net outflow present value in this investment for this company using a loan as your deductibility of 885,000. But if I decide to lease this asset, the $1.5 million asset, the lease is $400,000 a year, of which the after taxes I can deduct, and thus my true cost after taxes is not 400,000 but $240,000 a year, because that $400,000 is a business deduction, a business expense, so I get some tax break. So pretty simple. Notice I have no depreciation. Notice I have no loan payments or interest payments. So basically, my cash flow is the cost of the asset after taxes and the lease. Notice if I do that cash flow over 4 years, my discounted investment is $777,000. In other words, in this example, I'm saving $108,000 by leasing instead of purchasing this asset. Now, the primary reason for this is the short length of the life of the asset. The interest rate is quite high. If the interest rate was even lower, it'd be even more of an advantage. So this is why I would probably lease this asset, because in the present value terms of it, of investment over the 4 years, it's costing me less. And the textbook likes to call this, and this is a textbook item that is used in a lot of business plans by many companies. It's called the net advantage to leasing. An original entrepreneur going out to seek funding for his or her business would show this as a way of them showing that they can have assets of the company, and that assets are generating less cost and cash flow than going out and using capital to borrow money to buy those assets. It's called the net advantage to leasing. And this is one of the things that you'll be using and working with as you go into your business career, of using discounted cash flows. We're doing that in the electric case. You did that in case number 2. Looking at the discounted cash flow in today's dollars relative to the investment over time. And in this case, the lease is cheaper. Usually what you'll see is, as the type of assets go out in life, 10, 20 years, the advantage to leasing reduces. And it's more of an advantage to purchase the asset because you have a longer time to depreciate, to deduct those expenses over time. And usually it's cheaper to purchase over a longer period of time. But again, it depends on the interest rate, depends on your credit and such thing. But this is a good thing to remember, a good spreadsheet to determine an investment, whether to buy an asset or lease an asset. Many of us make this decision a lot when it's the time to buy a car or lease a car. Sometimes it's cheaper, and even notwithstanding any financial implications, it's just more easy. It's easier for us to lease a car because we don't have the ability to borrow money or want to pay those high payments of a loan. But the bad thing about leasing, naturally, again, is you have to turn the car in after 3 or 4 years, and you only can drive a certain amount of miles every year, or your payments on that lease dramatically go up. So ownership has benefits. It's just that at the time you want to own an asset, is it economically feasible for your credit and to borrow money? So that's one of the key last points of this class in corporate finance: alternatives to investing, alternatives to raising capital. One is leasing. Another naturally is finding a partner, merging your organization with another organization, or partnering up on a specific product or a specific market. Many companies partner up with a product, not partner up for a whole company, but merge with another organization to sell a particular product or in a particular market area of the world or of the country. So there's many alternatives out there, and we didn't in an 8-week class. We just don't have enough time to go over those, but should be aware of them. And we're talking about them in these last couple weeks: merging, consolidating of a business, taking over businesses, hostile takeovers, not so hostile takeovers, friendly mergers, and then lease financing. But lease financing, especially for many businesses, a sound alternative to going out and borrowing money. So this is a nice spreadsheet that shows that. So as we finish up this 8-week class, what have we have accomplished? Well, we've learned the basic structure of corporate finance revolves around two areas: the ability to understand where your business is by looking at financial information, credit information. What are the trends of your business? Are you profitable? Are you going up and down? Do you have challenges due to your own efficiency or management structure? And then also, how is these financial implications relative to your competition, to the industry? Where do we stand in our competitiveness of our company to create value for our investors? And the second area is where to invest in assets that create profitability, that create cash flow, that create value and return for our investors. The strategic decision making of where to invest in and what is its cost, what is its return. And we spent a lot of the second half of our class concentrating on that, and you're summarizing that in your electrics case for a specific company. Those two areas, where we stand or what are the trends of our company, how do they apply and how do they tell us about our business? You've done two cases on that, case 1 and case 2. And how those trends are accessible and what they tell us about the relationship to our outside world, that was case number 3. And then making an investment decision or a recommendation based on our cost of money in the market and what we can generate from a return of some alternatives to products or markets that we can compete in. And is that return sufficient enough to select one of those products or have an option of either both of them or none of them to go forward in the future to create corporate strategy and financial strategy for the company in the future? And that's what we've done in this course. And you've done it in different platforms of presentations, and you've done it in different ways of interpreting financial data and capital data. And I think we've done a pretty good job assessing that. That leads you into your final courses in the MBA program and gives you a firm base of being a leader and doing strategic understanding of businesses and the financial aspects of those businesses. So please, if you have any questions over the next 3 days, I'm around all weekend. Make sure you can complete your course evaluations, and I'll have all the grades posted in a week on Thursday, December 22nd, posted to Blackboard, and you can find your grade for this class. And besides all that, I wish you all the best of health and happiness this holiday to you and your families. Please be safe. And again, as I've talked about before in this class, if you need any letter of recommendations, need any information down into the future, I am now part of your network. You are a colleague of mine as you complete your MBA studies. If you need any data, need a reference, need information, this Blackboard site will be open for 5 years after we leave it this next week. You can go back and access information or access data from this class for other classes or even for work. Take advantage of that D&B Hoover's database as you leave the MBA program. You have access to that going forward outside of your MBA program. So anything you need, you know where to find me. I wish you all much success. Thank you for your efforts, and we'll all see you down the road. Thanks, everybody. Adios.